Okay, good day audience. Assalamu alaikum. This is your trainer, SBR trainer Mustafa Mirchawala from Mirchawala's Hub of Accountancy. Uh, today we are going to discuss question number 3 of September December 2020 attempt, a very latest past paper. Okay, and this past paper is full of intangible asset plus IFRS 5 plus IS 36. Normally these standards are also connected, and as predicted, I predicted that because of this COVID thing, there is a lot of restructuring, there is a lot of closure of branches, right? So that's why IFRS 5 is expected. Because of this COVID thing, listen, because of this COVID thing, uh, big lockdowns and a lot of disturbance. That's why this is the hint of impairment. So IS 36 is also expected, because normally ACCA gives you a question related to what is happening in the global environment, right? So this is the hot topics. Similarly, you might have observed that in this COVID era, in this 2020 2021, technological stocks went up. Apple stock, Google, Facebook, these Netflix, these all technological stocks went up, and technological stocks are highly dependent on intangible assets. So now intangible asset is also a very hot issue. So in this question, they have as this is the recent question, so examiner has covered all these recent issues. Okay, right? So you can predict paper through seeing the environment, what is happening in the environment, right? Now, question number 3. Question number 3. Corbel Company. Corbel Company trades. Corbel Company trades in the perfume sector. It has recently acquired a company, that means a takeover, for its brand. For its brand Jangi, purchased 2 additional brand names and has announced plans to close its Italian stores. See, that means there is a takeover. There is a takeover, and what is the need of takeover? To strengthen our brand by acquiring another brand, to give strength to us, right? And they are also going to close some Italian stores because they are in losses. So this closure giving me hint of restructuring, this closure giving me hint of IFRS 5 discontinued operation. Now, Carbel Company also opened a new store on a prime site in Paris. The current financial year end is 31st December X7. The current financial year end is 31st of December X7. Okay. Now, this is the first paragraph. On 1st of January, acquisition of Jangi Company. This is the first issue. On 1st of January X7, Corbel Company acquired 100% of Jangi Company. This is September 2020 past paper. September and December 2020 past paper. Listen. On 1st January X7, Corbel Company acquired 100% of Jangi Company. Both companies operate in the perfume sector. Okay. Corbel Company intends to merge the manufacture of Jangi Company's products into its own facilities and close Jangi Company's manufacturing unit. Now, what does it mean? You have acquired that company. Corbel acquired Jangi Company. And what is the purpose of acquisition? We'll close the manufacturing unit. We'll close the manufacturing unit of that Jangi Company, and we'll do manufacturing ourselves, but still we'll use their brand name. Okay, right? So this will create synergies as well, because now there will be a single manufacturing unit of us, and we will be serving more people. So work will be done in quantities. Just think, previously parent company. Now listen. Okay, so previously they were working separately, two manufacturing units, and now there will be only one manufacturing unit. So that definitely this will create synergy, this will create cost cutting. Okay, but definitely we'll be using their brand name. Now, Jangi Company's brand name is well known in the sector. retailing at premium prices, and therefore Cargill company will continue to sell products under the Jengies brand name after its registration has been transferred, and its manufacturing units have been integrated. The directors of Corbill company believes that most of the value of Jengi company was derived from the brand, and there is no indication of the impairment of brand at 31st December X7. This is the story. I hope you got some points. That parent company is acquiring running business of another company. Okay, and what is the objective of this takeover? To close down their manufacturing facility, because now there will be only one manufacturing unit. And secondly to merge secondly to merge the brand and to increase the sales, volume. Okay, now wait, and let's read the requirement number one. It's very general requirement. See this. Describe the main challenges in recognizing and measuring intangible assets such as brands. Specifically, they are talking about brands. Now wait. In the statement of financial position, now wait, let me explain you something. Listen, you know, in your very basic studies, in your beginning studies, you have studied this, that internally generated brands and internally generated goodwill, cannot be capitalized. You know why? What is the logic behind it? They are intangible asset, yes. Internally generated brand and internally generated goodwill are intangible asset, obviously. Why? Because they meet the criteria of intangibles. Yes, they don't have any physical substance. Please, active. They don't have any physical substance. Number one, they are identifiable, separable. Yes, they are identifiable and separable. They meet this definition. They are non-monetary. But what's the problem? Why we can't recognize internally generated brands or internally generated goodwill in our books? Why it's not allowed? It's not allowed. Listen the reason. Because IS 38 says that intangible assets are initially recorded at cost. Intangible assets are initially recorded at cost. And you cannot calculate the cost of internally generated brand or internally generated goodwill. You cannot calculate the cost of internally generated brand or internally generated goodwill. Why? Let me give you example. Listen, my goodwill. I've been teaching in more than 40 plus countries. So definitely many students comes in each and every next attempt we get new students. So that's a goodwill. That's why new students are coming. It's a goodwill. That's why new students are coming. That's why you guys are attending the class. Now, how did I make this goodwill? Think over it. I've been teaching for last 15 years, and since in these last 15 years I have given service to students. The students message me, I reply them. Sometimes they message me late night, I late night reply them. So this all service creates this goodwill. Can I calculate, listen to me and think over it, can I calculate the cost of all these efforts? No. How can I calculate the cost of late night message? How can I calculate the cost of thank you, greetings, smile? So we cannot calculate the cost of internally generated brand or goodwill. That's why we cannot capitalize. This is the real issue. This is the reason. You must know this. Sometimes they ask in the interview as well. So first issue which we will be discussing here, listen, is describe the main challenges in recognition. That this is, you cannot recognize internally generated brand, but yes, you can recognize the purchase brand. What is the example? You are P company and you acquired S company. You are P company and you acquired S company. And S company has internally generated brand. You are P company and you acquired S company, and yes, S company has, let us say, internally generated brand. So that brand has not already recognized in the S company, because for S company that brand is internally generated, but as parent company is buying, the running business of S company. So for parent company it's purchase brand. For parent company this brand is purchase brand. So yes, parent company can recognize it at fair value. Parent company can recognize it at fair value at the date of acquisition. And this you have done in your previous studies, even in the F7 course, right? And this will be treated as a fair value adjustment. This will be treated as a fair value adjustment at the date of acquisition. This will be treated as fair value adjustment at the date of acquisition. Remember how? Let me explain you. Listen. See, for example, you have bought this company for 100. This company has building of 20. This company has machine of 20. Now 100 minus 20 minus 20, goodwill is 60. Goodwill is 60. Right now we have paid for the whole running company, we have paid 100. For the whole complete company we have paid 100. Now out of this 100, building is 20 and machine is 20. So that means the residue is goodwill, right? This is the first calculation. Now as I was doing this calculation, suddenly my accountant came. He said, sir, there is one problem. I said, what? Sir, out of this 100, we got this building for 20 and machine for 20. And yes, we got one brand. We got one brand of 30. We got one brand. Brand is also present in S company, and that is separately identifiable. So automatically, I would say now my goodwill is 30. Now my goodwill is 30. Remember, you used to do this in your F7 studies, basic studies, that at the date of acquisition, when parent company acquires S company, and if there is any internally generated brands with S company, so parent company recognize it. Right? Because for parent company it's purchase brand. Because for parent company that brand is purchase brand. Okay, so in this part, see this part, this is very general part. In this part, describe the main challenges in recognizing. So first of all, you will discuss that you cannot recognize internally generated brand, and you will have to give the logic as well, which I have given you. Because IS 38 says internally generated brands. IS 38 says intangible assets are recorded at cost, and for internally generated brands and goodwill you cannot record the cost, you cannot calculate the cost. I gave you example of my 15 years teaching. That I cannot calculate the exact cost. Okay, that's why the cost cannot be measured reliably. Now the second issue in this case, recognizing, and the second issue is measuring. Listen, in this case of parent and subsidiary, see this case, when parent company acquires running business of S company, that means parent company has bought S company. So for parent company this brand is purchase brand, and yes, you can record purchase brand, and yes, you can record purchase brand, it's allowed. So now at the date of takeover, parent company will calculate the fair value of this brand. So now a new challenge, how to calculate the fair value of the brand. Let me remind you some IFRS 13 thing, how to calculate the fair value of brand. Just listen. Do you think that the brand has an active market? Brand has an active market? No, not at all. Active market means, what do you mean by active market? Active market means that brand is sold on a daily basis, that brand name is sold on daily basis. That's not possible. Yes, wait, perfumes are sold on daily basis, but perfume is inventory. I'm talking about the brand. I'm talking about the brand name, like the franchise rights of brand name. So that's franchise rights are given after every 6 months or 1 year. A new store opens after 6 months or 1 year. So this is not active market. Brand is never traded actively in the market. Brand, I'm not talking about the inventory, I'm not talking about the jeans, no, I'm talking about the brand name. So there is no active market of brand name, it's not traded. That's why you cannot calculate fair value through active market or through quoted market. That's not possible. So definitely you need to use different valuation techniques. You need to use different valuation techniques. For example, wait, like future cash flows of present value, like present value of future cash flows, and such techniques to be used, such techniques to be used. Okay, giving you 30 seconds to settle down, to think over it, please. So, my dear student, two words on which you have to discuss: recognizing and measuring. Recognizing and measuring. And one small thing which I would recommend you to discuss here is cost model and revaluation model. You know, in IS 38, there are two models. In IS 38, there are two measurement models. One is cost model and one is revaluation model. You all must know what I'm going to say now. Listen, in IS 38, if you want to apply revaluation model, in IS 38, if you want to apply revaluation model, then in that case, for that intangible asset, there must be active market. This is the requirement of IS 38, that if you want to apply revaluation model on a certain asset, then that asset must have an active market. Do you think brand has active market? No, brand does not have any active market. That's why brands cannot be recorded using revaluation model, right? This issue should also be discussed. So let's see the points. We have just discussed this first requirement. We have just discussed this first paragraph. We haven't done the whole question, only the first paragraph and the first requirement. First paragraph and the first requirement. See this. Now let me show you how to write it. Listen. See the screen, please. First of all, very easy. Simply write the recognition criteria. I told you that intangible assets, IS 38 says that intangible assets are recorded at cost. See, recognition criteria of intangible asset is that they are initially recorded at cost. Cost. What do you mean by cost? Do you know the meaning of cost? Cost means whatever we are paying, to acquire, okay. So for internally generated brands and goodwill, cost attributable to them cannot be measured reliably. Yes, that's a fact. I told you my last 15 years of service, I cannot the goodwill which I have generated, I cannot calculate the cost. It was lot of multiple efforts, in day, in night, through message, through talk, yes, through help, right? That's why they cannot be recognized in the financial statement according to IS 38. According to IS 38, right? Now, but purchase brands can be capitalized. See, you have clearly identified, but in that case, also many valuation issues. Wait, purchase brands we can capitalize, but normally purchase brands are acquired through takeover. So when parent company acquires subsidiary company, subsidiary company, parent company values the brand at fair value at the date of acquisition. So now there is an issue of valuation. Now wait, also I have discussed the intent. IS 38 allows two models for intangible assets, because in the question it was written about the measurement. Issue. So that's why I have discussed the two models. The first one is cost model and second one is revaluation model. See this. But revaluation model is only allowed if active market for that intangible asset exists. active market for that intangible asset exists. In case of brand, as they are not traded actively, that's why there is no active market of brand. Okay, now hold here, pause. But still there is no active market, but still at the date of takeover you need to calculate the fair value. At the date of takeover, parent company needs to calculate fair value of the brand in order to make the entry, in order to recognize that brand. Okay, so how we can calculate? See, also each brand is different from other brand. Yes, the shoes brand are different, the clothing brands are different, the shampoo brand are different characteristics. So one brand, there is no similarity, there is very less similarities between brands. Okay, so that's why you cannot use the fair value of one brand for another. You cannot use the fair value of one brand for another. So in that case the best thing is valuation technique, like present value issue, like future cash flows present value, the best thing. That's why it is very difficult to value. When at the time of takeover, see the issue, fair value of brand is calculated, then normally the company uses, open your eyes, valuation techniques which are complex. Measurement is more complex when intangible assets are not based on legally enforceable rights. Listen, sometimes it happens that intangible assets, we don't have any legally enforceable rights. So when you don't have any legally enforceable rights, that means the future cash flows are not certain, the future economic benefit is not certain. So in that case it is very difficult, to value that intangible asset, to calculate that future cash flows, because they are risky. You are not sure whether you will get those future cash flows or not. Now, sometimes the buyer of brand has different intentions, like, now wait, sometimes what happens, when parent company acquires the brand, they have different objectives in their mind, why they are acquiring. In this question, I'll show you the second paragraph. See the second paragraph now. See this See the second paragraph. Acquisition of perfume brand. In addition to now owning the Jangi brand, Corbel company has acquired two other perfume brand names to prevent rival companies acquiring them. Listen, just think over it. Why we are acquiring more perfume brands? So that our competitors do not acquire them, just for defensive purpose. We are not interested in acquiring new brands, but we are just acquiring these perfume brands so that our competitors stay away from this brand. The first perfume, Locust, has been sold successfully for many years and has established market, and the second perfume has been named. This issue is different, leave it, this is related to second requirement. But just these two lines, first two lines of this second paragraph, what does it means? Why are we acquiring the brands, these new perfume brands? We are just acquiring these new perfume brands so that our competitors stay away. That means we are not directly interested in brands. So our intentions are different in this case. So these intentions also affect the fair value. These intentions will also affect the fair value, because now we are not going to do more marketing for these brands which we have acquired. See this now read it. Sometimes the buyer of brand has different intentions, like Corbel bought for defensive reasons. Corbel bought for See this. Corbel bought for defensive reasons, so that our competitors do not acquire them. And this thing also affects future cash flows and valuation. Now just read it for a minute, then I'll go forward. Now listen. That's why intangible asset is a technical aspect of accounting. Now, see, just think about practically. See this phone is a tangible asset, you can touch, this pen is a tangible asset, we can see. But intangible asset is an asset which you cannot touch, even sometimes you cannot see. So it's a perception based asset. Intangible asset is a perception based asset. Wait, let me give you example. I ask, let us say we are sitting together. Please involve. You will understand. We are sitting together and we are discussing about KFC brand. So you ask me, how do you like KFC? I said it's okay, but maybe in our gathering there are some people who like KFC a lot. So it's about the choice. It's about the perception. It's about the taste of people. So in for intangible assets like goodwill and these things, it's very difficult to value because different people perceives that intangible asset differently. Wait, one more example. We have seen this. There are some teachers, few students like them a lot, few students say he's not a good teacher, we don't like them at all, like him at all. So it happens. So intangible asset, these goodwill, these brands, they are linked to human perception, human taste as well. So when there is an element of human taste, human perception, so this is very subjective thing. So that's why it is also difficult to value them. That's why it is also difficult to value them. I hope you got my point. So one more practical problem arises in case of internally generated intangible assets which are not recognized because in real sorry, first paragraph, red pen. That's why intangible asset is a technical aspect of accounting, as you cannot see it. Plus, it is a perception based asset, means for one party's view it is asset, but not for other party. Some people say yes, we like them, and others say we don't. So this is also one very big problem, very big and very scoring point. Now, one last extra point I would like to raise, and this is the reality. You know, I'm talking about internally generated brand. It is not recognized in your books. Internally generated brand is not recognized in your books. If it is my brand, if it is my internally generated brand, I cannot recognize in my book. Okay, but still I'm getting benefit. Still I'm getting benefit from that brand. I'm getting benefit from the brand, but I have not recognized it. So when I'm getting benefit, that means I'm earning from that brand. It's increasing my sales, it's increasing my profits, it's increasing my EPS. Okay. And when it's increasing my EPS, so it's increasing my share price as well. So the market analysts have included this internally generated brands in my valuation when they are valuing my share price. But when you see the SOFP, when you see my SOFP, it's not present. So this thing also confuses the users. This thing also confuses the users. You're not getting. I repeat, listen. For example, if a brand is internally generated for me, then I will not recognize in my books, not recognize, because IS 38 does not allow. Okay. But still that brand is giving me benefit. I'm earning through that brand. So that when I'm earning through that brand, my sales will go up, my profits will go up, my EPS will go up. So my share price will also go up. So the market analysts, those who are calculating the share prices and predicting the future, they will include that brand in their calculation. And in my share price, stock market price, the value of this brand is included. But when you see my SOFP, my statement of financial position, that brand is not present. So this also creates clash. This also creates clash in the mind of users. And one more thing, for analysts it's also very difficult to value this brand because it's not present, but still we are getting benefit. Now read it. One more practical problem arises in case of internally generated intangibles which are not recognized because in reality they do exist. Yes, they do exist. So many analysts includes them in their valuations, but they are not present in SOFP. Just think, student, just think. Internally generated brands are not present in your SOFP, but yes, they they are reflected in your share prices because you are enjoying the benefit of this internally generated brand. Use your brain. If you see the name of my institute is Mirchawala's Hub of Accountancy. We have some star teachers with us. So we have not recognized the goodwill or brand of their teachers, but yes, we are earning from that teachers. Think over it. So these brands are not in your SOFP, but they are reflecting in the performance of this brand is reflecting in your income statement, sales, profits, and then share price and all. Did you understand? Did you understand this part? Yes, this is technical. Yes, this is technical. It's professional SBR level. Did you understand this part? Please write on the chat box. Those who joined late, I'll provide them recording. Those who joined late, I'll provide them recording. Don't worry. But now, from this part, be very attached. Okay. Now let's move to the remaining part of the question. Now listen. This is the second paragraph. This is the second paragraph, students. In addition to now owning the Jangi brand, Corbill Company has acquired two other perfume brand names to prevent rival companies acquiring them. Okay, simply we have written the intention. The first perfume, Locust, has been sold successfully for many years and has for many years. That means it's a very old brand, very famous old brand, and has an established market. The second is a new perfume which has been named after a famous actor Clara, who intends to promote the product. The directors of Corbill Company believe that the two perfume brand names have indefinite life. Very interesting issue, and I can assure you this thing came in 2008. I saw this question in 2008. I forgot the name. The name of was from S, I think. I forgot the name. In 2008, December 2000 attempt or June 2008, this question exactly this question came in exam. It's coming again. It has been repeated again. And in my lectures, this issue is discussed. In my lectures, this issue is discussed. But don't worry, I'll explain you. Read the second requirement. Discuss the following accounting issues relating to Corbill Company's financial statements for the year ended 31st December X7 in accordance with IFRS standards. In according with IFRS standards. Number one point, first point, whether the Jengi company brand name will be accounted for separately from goodwill on acquisition. First issue. First issue. Wait. Parent company. Students, I really want your energy now. Very extreme focus towards me. Parent company, this is related to the first paragraph. Parent company just acquired this Jangi company, and this Jangi company holds one brand. So they are saying whether the Jangi company brand name will be accounted for separately from goodwill on acquisition. Wait, this issue I've discussed here. See this, all of you. This issue I have discussed in this diagram. In this diagram I have discussed. Yes, you can record it separately. You can record this brand separately if it meets the definition of intangible assets, and if its valuation can be done separately. Yes, if it meets the definition of intangible asset. Yes. And and listen, and the fair value of this brand can be calculated, then you can easily record it separately. Yes, this is the answer. I'll discuss this, don't worry. Now the second issue of this question, and whether it should be accounted for as a separate cash generating unit after the integration of the manufacturing units. Excellent part. Excellent part. You know, can can you guys tell me the CGU thing? Do you know the definition of CGU? Smallest, listen to me, smallest group of assets that generates independent cash flows. Smallest and identifiable group of assets that generate independent cash flows, and they are not dependent on any other thing. They are independent cash flows. Now listen to me. Just a brand name. Look at me. Just a brand name without manufacturing facility, without any facility, just a name. Just a name. Can that name generate independent cash flows? Big no. Big no. Big no. No, 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 no. Why? Giving you example. Listen. Let us say there is a shop. There is a shop, and in that shop, big board of McDonald is placed outside. There is a shop, and there is a board of McDonald outside that shop. But when you entered in that shop, there is no burgers. There are no burgers. There are no fries. There are no ice cream. Nothing. No facility available. Just McDonald name is written. Will you give any cash? Will you buy anything? No. That name is nothing without that combination. That name is nothing without the service facilities and all. Not getting. Student, just think. If somebody says you, if look at me, if I say you that I teach this and I have been teaching for last 15 years many things, so you'll say okay, I'll buy the lectures. But in the end I say I don't have lectures, just name. You will say go bye bye. We don't want anything, because the brand name with facilities is must. Only name does can't do anything. Name with facilities. KFC with facilities, McDonald with all services, then with all setup, then people will pay money. Otherwise, nobody will pay. Otherwise, you can't generate cash flows. Not getting. So it is openly written in the IFRS that brand name are not CGUs, because a separate brand, listen to me, a separate brand cannot generate independent cash flows separately. Yes, it can generate cash flow with the combination of facilities. Oh, did you understand this point? Reply to me, please. All of you, please reply. At least this is my tip. If you replied, it's my tip. Okay, so the concept is a separate brand. A separate brand is not a CGU, because it cannot generate independent cash flows. Yes, it can generate with the combination of other facilities. So now what we do, for example, we have, listen to me and open your mind. We have a brand, one brand, let us say KFC. We have one brand KFC, and we have 15 shops, 15 separate shops that are generating cash flows. So yes, you can allocate, this is allowed, you can allocate your brand to different CGUs. It is written in your book as well. You can allocate that brand to different CGUs on whatever basis you want, different basis you want. So then this is fine. Or if you cannot allocate the brand to separate CGUs, then you can allocate to group of CGUs as well. That is to group of facilities, group of CGUs, yes. But never ever think that a separate brand name is a CGU. No, because separate brand name never generates independent cash flows. Okay, so two issues to discuss in point number one. In B point number one, two issues to discuss. Read it, don't sleep. These are last days of your exams. The first issue, the answer is yes. The brand can be recognized separately from goodwill. See this diagram. All of you, let me enlarge. See this. If brand has a separate value, yes, you can record it. Okay, so let me discuss with you, students, dear students. Look at here. See this requirement B part 1. The Jangi brand meets the definition of intangible asset because it will give future economic benefit through increasing sales volume. Yes, if you have the question, you can read it. It's September December 2020. Listen. What was our intention in acquiring Jengi brand? That it's a very super hit brand, so definitely we'll work on volumes now. We'll get synergies. So yes, this brand will give us economic benefit through increasing sales volume and brand image. Now, in the criteria and conditions of intangible assets, you guys have studied that you must have control. You must have control over that intangible asset. So it's not difficult. See this. Control over these economic benefits can be established through registration of the brand. You just when you acquire certain company, you do paperwork. When you acquire a certain business, you do paperwork that from now onward this belongs to me. So yes, if you have done all the paperwork, if you have done all the paperwork registration work, then it's safe, it's your brand. So yes, then you can control the economic benefit very easily. That's why it should be recorded separately from goodwill, and should be recorded at fair value. This is the answer of the first line. Be confident, student. Giving you one word: treat yourself as a winner. Treat yourself, all of you, treat yourself. Just think that you guys have cleared the paper, and you are going to clear the paper. Just think, be confident, don't think negative. These ending days are very important for you. Now, one more thing. Now then you have to write, in your question you have to write the state the rule. You have to write the is as well. So now I'm giving you pointers. From now onwards in solution, I'll giving you just pointers. Okay, you are no more kids. Be active. Now next thing is definition of CGU, which I just told you, right? Definition of smallest group of identifiable assets that generate independent cash flows and are not dependent on other assets, right? Now this thing is very important. I have just discussed with you during the question discussion. Brands are not separate CGU because brand does not work alone without associated manufacturing facilities and other assets. I told you that just the name of McDonald won't give you any earning. You have to give service with inside the McDonald, right? That's why brand would be separately identified and valued. It should be allocated to each of Corbel's CGU that are expected to get benefit from synergies of the combination. Now go slow. Wait, these last lines are very important. I told you, listen, because we have acquired this brand, and because of this new brand name our sales will go up. So for example, listen, we have acquired this brand name in Italy. For example, it's just an example. We have acquired this brand name in Italy, and outside Italy nobody knows this brand name. Only Italy people knows. And let us say we have 20 branches in Italy. Let us say, for example, just for your understanding, let us say we have 20 branches in Italy. So all 20 branches of Italy will get benefit from this brand name because we have acquired it. So now we will apportion these brand name on only Italy branches. Not getting? Now read it. That's why brand name would be separately identified and valued. It should be allocated. See, this is the treatment. Allocated to each of Corbel. Corbel is the parent company. Company's CGU that are expected to get benefit from synergies of that combination, from synergies of that combination, from synergies of that combination. Now, one extra line, if brand cannot be allocated to individual CGU, then IS 36 permits to allocate brand to group of CGUs. Yes, there are combinations of CGUs, you can allocate to them as well. You cannot, you can allocate to them as well. This is also allowed. Okay. So this was the treatment. It's not difficult. It's not difficult. You just need your attention. Just need your attention. Did you understand? Please reply. All of you, please reply. All of you. Are you with me? Are you with me? Now listen. Now let's go to the third requirement. Third requirement is my favorite requirement, is the easiest requirement, easiest. Listen, this requirement 6 marks. Sometime I say free marks. See this, these are free. These are free marks. These are, believe me student, these are free marks because it came previously. They repeated this, you know, in my routine lectures I have discussed this issue. Those who are my students, they are attending, they know this. I have discussed this issue when I was whenever I teach IS 38, even in F7 level, in FR level, whenever I teach IS 38, I give this example. Whenever I teach IS 38, I give this example, and the same example they have given after 12 years. See the repetition. Yes, I got the name. Celtech. This was the name. In 2008, the past paper name was Celtech. Still, you can verify. You guys can check. Celtech was the past paper in 2008. It came in 2008. Same thing they have given you again. And 6 marks. 6 marks is not a joke. You just need 50 to pass. That's it. The first objective is to cross the border. Is to cross the borderline. Now, let me discuss you in very detailed style. Please look at me and concentrate. Concentrate. Please don't use your phone, nothing. Just you and me. Dear students, there is an issue that intangible assets may have finite life, may have indefinite life. Listen, may have finite life, indefinite life. Finite life means which can be calculated. Finite life means that you can calculate the economic benefit, you can see the end point. For example, you will get the benefit next 5 years or 4 years or 3 years. Okay. So in case of finite life, you amortize, listen to me very carefully, you amortize your intangible asset, yes, from the date when it is available for use. You amortize your intangible asset from the date when it is available for use in case of finite life. Now, in case, what is indefinite life? Indefinite life is the life, in that case you can't calculate the end point. You cannot calculate the ending point of economic benefit, that till how many years you will get economic benefit. Or you can say that indefinite life is the life which cannot be calculated, listen, in case of indefinite life, you don't need to do any amortization. You don't need to do amortization, and you can't do amortization. Even you can't do amortization. You can't do amortization because there is no finite number of life. But in case of indefinite life, you need to do impairment testing at least annually. At least annually impairment testing is must. Please, the student, look at me. At least annually impairment testing is must. At least annually impairment testing is must. Okay, at least annually impairment testing is must, or whenever you get impairment hint. Yes, this was the introduction. Now the real issue, listen. How to decide whether this brand or whether this intangible has finite life or indefinite life, whether this brand has finite life or indefinite life. Listen, you first of all, you need to check, first of all, very important part of my lecture now. First of all, you need to check the past performance of that brand, that how that brand worked, how that brand defeated the competitors, how that brand cleaned the market. So for example, there is a brand named Coke. Have you heard about Coke? Yes, all of you. So Coke came in this world in 1886, almost 136 or 137, 138 years back. Coke came, and you can see that Coke is not a technological product. It's a drink. It's eatable. It's a drink. So when it is not related to technology, that means less risky. Plus the past performance, the perception of people that Coke is king. So can you guys, I challenge you, all of you, can you guys calculate the finite life of Coke? Can you guys calculate the finite life, the ending point of the brand of Coke? No, we cannot. So if a brand is very super hit in past, if a brand has defeated many competitors in past, if the brand is non-technological brand, that means not dependent on technology. Listen, if the brand if the brand has good future as prospect. And one more point, if we are the acquirer, if we are as an acquirer ready to invest in that brand, if we are as an acquirer ready to do input in that brand, that means that brand has indefinite life. Okay, you got it. So these were the general factors. Now let's go specific. Please, 1 minute. Sorry, I'm taking your time. See this, acquisition of perfume brand. Students, please. The first perfume locust, the first perfume, see this, the first perfume locust has been sold successfully for many years. I gave you example of Coke. Oh, it's very old and has an established market. The second new perfume which has been named after a famous actor, Clara, who intends to promote the product. Now, wait, student. In my eyes, as per my perception, the first brand has indefinite life because it's very established brand working for many years. There is nothing about technology or such things, right? Okay, nothing. Yes, perfume is non-technological thing. Perfume is not a technological based thing, right? Plus, it looks like they have established market so that their future is also bright. So the factor says that it has indefinite life. Yes, I can go for indefinite life, but the second brand is named after a film, a famous actor who intends to promote the product. Now listen to me. Actor is a human being and human being has a finite life. Actor is human being and human being has finite life. So once the fame of this actor will go down, as this brand is connected to the fame of that actor, once the fame of that actor will go down, the brand will go down, and one day definitely this actor will die. So in that case, the second brand looks the second brand, I should say it's finite life, right? Okay, because it is dependent on this human being. Did you guys got understand? Please reply, just few points. Now let me show you the pointers. Now I've just given you, I've just written the pointers. Okay, listen this. So first of all, you, in this case, you need to write the definition. You need to write the definition of, listen, you need to write the definition of indefinite life, okay, and finite life, which I just told you. Then You need to discuss the amortization issue of indefinite life and finite life. In finite life, yes, you do amortization. In finite life, yes, you do amortization once it is available for use, once the intangible asset is available for use. In indefinite life, you don't do any amortization, but yes, do impairment testing. But you do impairment testing. There is a question that sometimes, yes, sometimes when some actors dies, their brand still exists, but for that case it should be written that listen, that brand name has its own value. There should be, these hints should be given in the question, these hints should be given in the question. So listen to me, and if you have read the examiner report, or if you have read, listen to me, the sessions conducted by teachers training sessions conducted by ACCA UK, so they have clearly said this, that in SBR paper, that's the positivity of SBR, there is a headroom available. Headroom means multiple solutions are also accepted, they accept multiple solutions. So if somebody, there is one student has given me a point, that if somebody, sometimes it happens that after the death of that actor, the brand goes on, or brand gets more sympathy from the death. Yes, it happens. So you can write it as an exception, is an exception. But when the 2008 question came, it was clearly written in that 2008 question that whenever the movies of this actor get get promotion, get good value, the brand also goes up, and whenever the movie gets flop, the brand gets flop. So that means in that case, and it's human, this guy is human, that means that market perception is connected to that human guy, that's why. Okay. Now, next thing, impairment testing issue. You need to discuss impairment testing issue. Then, one very important issue, let me explain you, the review of life. Review of life. This is the speciality of IFRS, International Accounting, International Financial Reporting Standards, that whatever things are estimation based, you need to value at the end of each year. Like in IS 16, you need to revise, you need to check, you need to revise the life, useful life, you need to revise the scrap value, residual value at the end of each year. This is the requirement of IS 16. Listen. So just think, listen, look at here. For example, I bought brand here. I bought brand on 1st of January 2020. All of you look at here. I bought brand on 1st January 2020. Right now, I acquired a team of expert, and I gave them data that check the life. They said the life is indefinite. The life is indefinite. We cannot calculate. We cannot see the end point. But after 1 year, see this. This is 1st of January 2021. Now, after each reporting date, after 1 year, new information will come. New info will come. So maybe after 1 year, when you provide this new info to your staff, to the experts, they may say, yes, now the remaining life is 10 years. Okay. So this is possible, that in last year, the life was indefinite, but this year the circumstances have changed. There is some new information regarding you. There is some new law has been passed. Okay. Then you can, if you cannot if you can calculate the finite life, then it's fine. And then from this date you need to start amortization. From this date you need to start amortization. Okay. So this issue you need to discuss as well, that review of life at the end of each reporting date. Now, then after that you need to discuss factor considering for finite and indefinite life. I told you the technological factors, that whether your brand is dependent on technology or not, power of brand, how much we are going to support that brand, how much we are going to support, we as an acquirer, how much we are going to support that brand. And not in case of Corbill. This point was negative in case of Corbill. Corbill, Corbill bought these brands just for defensive purpose. Corbill, the parent company, acquired these brands just for defensive purpose, just so that the competitors do not acquire them. So this point goes against that we are not going to invest anything, or we are not going to take interest in these brands because we have just acquired for so that our competitors cannot see them. Then risk associated with that brand. Finally, you know how to write it, application. In the end, you write to applicate, you have to do application. So for Locust perfume, the first Locust perfume brand, you will comment, you will finally give the final answer as indefinite life. And for Clara perfume brand, you will write finite life. You will write finite life, whatever I taught you, whatever I told you, in the same way. You got it? You got it, students. Now nothing difficult is left. IFRS 5 is easy. IFRS 5 you can easily understand. You can easily got it. Now this paragraph, this para, all of you please, all of you. No, 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 no. One student is saying that if we only write the application thing, no, 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 no. You have to write a little bit, state the rule. If you cannot write like me, still you need to write some points of state the rule. That's part of the strategy. But yes, listen, but if you are running short of time, for example, you have just half an hour and you have to complete the whole question, then write the application only. Yes. Read this paragraph, please. All of you read it, please. Listen. Corville Company approved and announced a plan to close and sell all six. See, a very important word, all six. I'm especially underlining all six Italian stores on 31st December X7. Close and sell all six on one date. One shot, six store in one go. See this. See the words. All six stores in one go on one date. On one date, in one transaction, one shot sale. This is giving me hint of one new word, and this is disposal group. I repeat, go slow. Corbill Company approved and announced a plan to close and sell all six Italian stores, all six, see the word, on 31st December. That means all six on one day, on one day. You know, you know the definition of disposal group. Let me explain you. Just think. Disposal group means you are selling two assets, or you are selling three assets. You are selling two or three assets. You are selling two or three assets in one go, or three asset, one liability in one go. Four asset, one liability, four chairs, one liability in one go, in one shot. If you are selling combination of assets in one go, then it meets the definition of disposal group. This is written. Okay. So you need to write this definition in this question. Now, the six stores will close after a liquidation sale, which will last for 3 months. Management has committed to a formal plan. See IS 37 restructuring, IS 37 restructuring criteria, IS 37 restructuring provision, formal plan word. I'm sure you guys know about it. For the closure of 6 stores, and has also started an active search for a single buyer. This is held for sale. And see, once again, single buyer means disposal group. Single buyer will buy all these things. Single buyer will buy all these things. No more multiple buyers. That means all things will be sold in one shot. The stores are being closed because of the increased demand generated by Corbel companies internet sales. See, this is a very practical issue. The whole world, this is real life issue. This is very common in all countries. I've read many articles on this. Now people are shifting from physical to online. See, this you're teaching, we are doing right now. We have many other countries, students are also attending. So we ourselves shifting from physical to online. Everywhere this is going on. A local newspaper has written an article suggesting that up to 30 stores may be closed with a loss of 500 jobs across the world over the next 5 years. Listen, the directors of Corbel have denied that this is the case. Now, this line has some different importance. Listen. This is just a newspaper story. We have no plan. We have last two lines, just a newspaper story. We have no plans, or nor our directors have approved it. Our directors has denied it. So no more importance of these two lines, because we don't have any formal plan for these two lines. Just a newspaper lines. These are just the newspaper lines. Okay. And the directors have denied that this is the case. Okay. Right. Now wait, let's read the next requirement. How to account for the proposed closure of the 6 stores and suggested closure of the remaining stores. They have not written any name. Wait, but I'm telling you, IFRS 5 and IS 37, and some discussion on IS 36 impairment. Okay, IFRS 5 and IS 37. Now wait, look at me. First of all, discontinued operation. If these shops meets the definition of component of an entity, if these shops meets the definition of component of an entity means if separate cash flows or revenues and costs are may be calculated for financial reporting purpose. Yes, if they meets the definition of component of an entity, and they represent a separate geographical line of business. Yes, 6 stores are too much. 6 stores are too material stores. So yes, in the income statement they will be reported as a discontinued operation. Right? Okay. So I'm sure you know that one thing is HFS, one thing is held for sale, and one thing is discontinued operation. All of you look at here. One word is held for sale, and the other word is discontinued operation. Held for sale is connected to SOFP, current or non-current asset, right? And discontinued operation is connected to SOCI. This is the very basic thing. Held for sale is connected to SOFP, that current asset thing, and discontinued operation is primarily connected to SOCI. So first of all, just think. Previously, you think with the view of shareholders. Listen, previously our shareholders were seeing that we are a company with many branches. But now, from now onwards, from next years, we won't have these much branches. Our major branches, 6 7 branches, physical branches, are closed. So now we should report this to shareholder that this operation is discontinued. This operation is discontinued, and please don't expect please don't expect anything from this operation. Okay, so discontinued operation accounting for income statement is appropriate here. Okay, now next thing is held for sale. Held for sale. For held for sale, one word is very important. I'm sure you are aware about the definition of held for sale. Held for sale are those assets, held for sale are those assets which principally gives economic benefit through a sale transaction, not from continuing use. That means the word sale is very important. Go and check the question. See, go and check the question. They see this. The word sale. Yes, the word sell is there. The word sell is there, right? Plus, see this active search. See this. That means held for sale criteria is also met. Held for sale criteria is also met. See, the indication of sale is there. Indication of sale is there. So you need to discuss little bit in theory. It's not a practical question. You need to discuss little bit of HFS accounting. You need to discuss little bit of HFS accounting as well. Let me recall you. Whenever you classify any asset or any group of assets, whenever you classify any asset or any group of asset held for sale, first of all you do impairment testing using IS 36. First of all you do impairment testing using IS 36. Then after impairment testing using IS 36, this is called before classification impairment testing. Then you shift that asset in held for sale, HFS, current asset. And after shifting to current asset, after shifting to held for sale, there is very simple rule. Recorded at lower of carrying value and fair value minus CTS, fair value minus cost to sell, right? After shifting to held for sale, once you shifted it to held for sale, you recorded it lower of carrying value and fair value less cost to sell. And this is the criteria of IFRS 5. This is the criteria of IFRS 5. Okay, so students, you need to write these things as well. And these things we teachers teach in class, we teachers teach in our normal class, normal IFRS 5 lecture. This is all included. Okay, so I'm just using the words, that's it. Now one more thing. As as this as the management has announced has as the management has announced the closure. So listen, as the management has announced the closure, so this is also the impairment hint. The announcement of closure is also impairment hint, so that's why the impairment testing is must. You can write this line as well. Now let's touch IS 37. Let's touch IS 37. You know, whenever you close the branches, that means you are going to fire. You close the branches, 6 branches, major branches. That means you are going to fire many employees. You are going to cancel many tenancy agreements. So yes, this is the clear hint of restructuring. This is a clear hint of restructuring. Now for that you need to make restructuring provision as well. Now students, what is the criteria for making restructuring provision? What is the criteria for making restructuring provision? Number one, you must have detailed formal plan. Yes, it is already there. See, you must have detailed formal plan. And number two, you have created valid expectation to those affected. You have created valid expectation to those affected. See, they have created valid expectation. See this, active search of the buyer. Active search of the buyer. The stores are being closed, and yes, some stores are already closed. So that means everybody can see that they are going to close the stores. So automatically the valid expectation has been created. Automatically the valid expectation has been created. So for IS 37, for IS 37 restructuring provision, for IS 37 restructuring provision, there are two conditions. Number one, detailed formal plan, it's already there. Number two, you have created valid expectation to those affected, right? So this thing you have to write, and yes, we'll make the restructuring provision. Finally, one last line, one last two lines. This thing, can you see this? There, a local newspaper has printed this story that this company is going to close 30 stores. This company is going to close 30 stores and there will be 500 jobs will be lost. Can we make provision? Can we make provision by this news only? By this by this news of by just this news of newspaper? No, never, never think over it, because IS 37 says IS 37 says you must have detailed formal plan. No more formal plan for last two lines. And you have created valid expectation. No more valid expectation. Even the director has denied that this is not the case, this is false news. Okay, so last two lines, no importance. And no more restructuring provision, no more held for sale, nothing. No accounting for last two lines. No accounting for last two lines. If you approach the question in this way, you can do it. You can do it. Think positive. Be confident that you can. These are general discussion. These are general discussion. You guys have studied last 3-4 months. Lot of accounting you have done. Now let me show you some pointers. I told you I can only give you now pointers. See, in this question, just for the state the rule, in the starting question you need to write the state the rule. You have to write the HFS criteria, little bit HFS criteria and their impairment testing issues. Impairment testing issues, I told you, before and after classification. Okay, then component of an entity, yes, discuss about that. These stores, if these stores are component of an entity, and as this represents separate geographical area of operation, that's why in the income statement they will be reported as discontinued operation. In the income statement they will be reported as discontinued operation. Then after that, disposal group definition. One point which we picked, that they are looking for a single buyer who buys everything together. And I told you what is disposal group. When you sell few assets, few liabilities, or just few assets in one shot, then it's disposal group. Okay, now approval and announcement of closure of stores is hint of impairment. Now wait, for example, I have 10 stores. Very interesting point I'm raising. All of you, please invest some time. For example, I have 10 stores and I have announced that I'm going to close 6 stores. I have 10 stores and I have announced that I'm going to close 6 stores. So it means there is some problem with there is some problem with the sales. Company is not going good. So now the remaining 4 stores, we have to do the impairment testing for remaining stores as well, because the overall business is affected. That's why company is going down. Company is closing stores. Okay. Then after that, I just told you restructuring provision discussion. I told you this, I have not written here. I'm just writing pointers now. Pointers. You have to do it yourself. Okay. Restructuring provision, detailed formal plan and all. Yes, restructuring provision. Then IS 36 discussion. And finally, newspaper is just a rumor. It's not a formal announcement. That's why no restructuring provision, no constructive obligation is there. Okay, so the last point, the last two lines, you don't need to do any accounting for that. You don't need to do any accounting for that. Yes, there is one question, sir. Impairment testing will be done for the remaining stores. Yes. Why? Because they have started closing the stores. That means there is something bad going with the company, right? चाय मंगाओ, चाय. Now, very last paragraph and last issue. Last paragraph and last issue. Please be with me. I will give you some practical examples of real life in this. Corbill Company's primary store is located in Central Paris. Corbill Company's primary stores is located in Central Paris. It has recently been opened at a significant cost, with the result that management believes it will make a loss in the current financial years. Very important line. Management already think it will make a loss. This is the perception of management. Management is ready. Management is ready for this loss. I will use this line in my solution, little pointers. Management already expect that the loss is there because of bad economic conditions. Simple, because when people gets lower income, they don't buy expensive perfumes. You got it? Right now it's time of recession. Right now it's a sort of bad time because of COVID. They have not used the word COVID, but I'm telling you, just this loss making is not of concern, as the performance is consistent with the expectation. Again, with expectation for such a new and expensive store. Yes, it's very common. When you buy Paris is very expensive, students. Rents are very high, and if you buy on Paris main streets, then do expect this loss. And they are expecting. And management believes that the new store will have a positive effect on Corbell's brand image. See this. Just think, sometimes we open such stores on big streets like Champs-Élysées Street, Paris, very famous street. Istiklal Street, Turkey. Orchard Street, Singapore, and so many. In New York, there is one street. In California, LA, there are some famous streets. So sometimes you open very expensive stores on that street, and that stores normally gives you loss because of you invest too much. But that stores give impression to the whole world that you have a store in that street. Champs-Élysées, you have a store in Champs-Élysées Street. You have a store in Oxford Street, London. So this sometimes this things gives impression to the whole public. You're not getting. Listen, students. This is the very real life, real all in strategic level paper. They give you real life scenarios. This is real scenario. Sometimes you open stores on the world's most famous streets, and you cannot cover the cost from that street. You are in loss. But that store gives the impression to the whole public that this is a big brand. So you earn from other stores because of this store. Because of this store, you earn from other stores. This is very important point. I'll connect it while discussion in the solution. Now, if impairment testing of the primary store were to be required, primary means this main store, this flagship store, Paris store, then Corbill company would include the cash flows. See the corruption now. See the corruption from all internet sales in this assessment. See, this is a little bad thing. When you are doing impairment testing of only that store, and why you are including internet sales? Internet sales is something different. That is online. Online is a separate department. Wait, the goods sold via the internet are sourced from either Corbill's central distribution center or individual stores from other stores. These sales are from other stores. Internet sales are either delivered to the customer's home or collected by the customer from store supplying the goods. This is called store pickup. Very common all over the world. Store pickup. You guys are well aware. Store pickup. Sometimes when we order online, they give you two options. They are either they deliver at your place, or you go to that store and you collect. Store pickup. It's very simple. Store pickup. And if you do store pickup, your shipping cost is saved. Your, as a customer, your shipping cost is saved. Okay. So these are two issues. The first issue is we have opened a very big store on a Paris main street, like Champs-Elysees street, right? Okay, listen. And this, and we are already ready that we'll get lost. We are already ready, and we are expecting that we will be in loss. So this is nothing new. The first issue. The second issue, they are saying, when we do impairment testing of this store, we'll include other store sales in our future cash flows, because whenever we do impairment testing, we calculate VIU, value in use. And for the calculation of value in use, we use future cash flows. So they are going to include the internet sales and other store sales for this calculation. This is totally wrong. This is totally wrong. If you are doing impairment testing of this store, use the sales of this store. Okay, right? But again, as a student, you may ask one question, sir, because, sir, what about this line? What about this line? See this, read this line. I've highlighted again. Sir, what about this line? That because of this store, we'll have a positive impact on the brand image. Because of this store, we'll have a positive impact on brand image, and other stores will also enjoy the name of the company. So how will you tackle this issue? I'll tell you, don't worry. Very interesting discussion. Giving you 1 minute to read it. Giving you 1 minute to read it and analyze it. Think over it. Now read the requirement. Whether the first issue, read requirement very carefully. First issue, whether the primary store should be tested for impairment at 31st December X7, hold. This is the first requirement. And whether the internet sales can be attributed to their store, to this store, this is the second requirement. Look at me. Can you look at me? Listen to me. For assets, for intangible assets with finite life, and for normal assets, we only do, listen to me, we only do impairment testing when we get the hint of impairment. We only do impairment testing. Students, please, last requirement, this is last. For normal assets and intangible assets with finite life, we only do impairment testing once we get the hint of impairment. Wait. And there are two types of hint of impairment. You have studied in IS 36, external and internal hints. External and internal hints. Okay, now wait. As such, we cannot see any hints. As such, we cannot see any hints in this question. Please listen my words. You will be able to write it. You will be able to write the solution. As such, there is no hints in this question. But yes, we can make one hint. Let me tell you. There is one hint. Whenever the asset's performance is lower than expected, we were expecting high performance and the real performance is low. We were expecting high performance, but eventually the real performance is low. Whenever this is the case, then yes, this is the hint of impairment. This is the hint of impairment. What is the hint of impairment? I repeat, whenever the expected performance, whenever the actual performance is lower than expected, we were expecting more and the actual performance is low. So this is the hint of impairment. But this is not the case of this question. In this question, it is openly written. In this question, it is clearly written. Listen, that management was already expecting loss, and yes, they got loss. So nothing bad. So that's why there is no hint of impairment. For the first point, there is no hint of impairment. So as such, they don't need any impairment testing. But yes, if they find any other reason in practical life, not about this question, in practical life, if they find any other reason or any other hint, then they can do it. But apparently in this question, there is no hint, and the point of loss won't create any impairment hint, because we already expect this loss, and management expectation in line with the actual results, it is written. So the answer of first question is this. The second issue is very, very, very technical. Student will ask, sir, we are making loss. Listen to me. We are making loss in this big store so that we get a good brand image. We are doing loss in this store so that we get a good brand image, and that brand image will ultimately affect all other branches. And all other branches will earn. So, sir, let's do it. Let's do during impairment testing, include their sales as well as your own cash flow. No, that's wrong. They are going to benefit. The other stores are going to benefit from our brand. So let's do one thing. Listen, treat all these costs which you have just incurred for this big setup as a corporate asset. Listen to me. Treat this all expenditure as a corporate asset, and allocate that corporate asset to everybody. Because everybody is enjoying. Spread the cost, apportion the cost of this corporate asset to everybody. So in this way, everybody will get the share of the cost. All other stores will get the share of cost, and that share of cost will ultimately affect their P&L one day. That share of cost will ultimately affect their P&L one day. Okay, so that means when they will get the hit of expense, so they got the due share. But you are strictly not allowed to take their sales as your own sales in impairment testing calculation, because when you are doing impairment of this store, this flagship store, just include the sales of this flagship store, because all other stores are different. Internet sales is totally different. Internet sales, people order from different locations, and they expect the service on that location. They don't want service from that Paris store. See, they are that setup is different, centralized. So the last point in the question was wrong. Okay, so what I told you regarding this. Okay, students, so now let's discuss. Listen, let's see how you can write it. So three issues I've told you. Three issues you need to discuss. Listen, three issues. The first issue is that there is no impairment hint, so no need to do any impairment testing. I have already told you. The second issue is that yes, this loss making unit will benefit all other stores. So we'll apportion. So we will apportion this corporate asset to all other stores. We'll apportion this corporate asset to all other stores, right? Okay, right? So that they will get the due share of the cost, and they will get the hit in the P&L as well. But strictly, you cannot book their sales as your own sales in the working of value in use calculation for impairment testing. That's not allowed, because their sales are different sales. Their own sales, right? Okay, let me show you. See this. First of all, in this case, you need to write indication of impairment is whether performance. See this. Whether the performance is worse than expected, this issue you have to write. Store, then you'll write store going in line with expectation. Store going in line with the expectation means no indication of, we were expecting, the management was expecting loss, and yes, the exact loss happened. So no need to do, no need to book, no need to do any impairment testing. Then, as other stores enjoying the brand name. That's why treat this as a corporate asset and apportion to other stores. Okay, this thing. And finally you can write, finally students, you can write that you cannot, finally you can write, you cannot include sales, of internet and other stores as your sale in the calculation of VIU. Okay, so these are the major points. These are the major points for this. These are the major points for this. Somebody is asking future operating losses. No, you cannot make provision for future operating losses, and no need to write about the future of IS 37 issue. This is not IS 37 issue. Okay, student. So I tried my best. To, so that you guys can understand. If I'm writing my number, if somebody does not have my number, you guys can contact me on WhatsApp. Okay. Right. So you guys can contact me on WhatsApp if you need any help. I'll send these slides to you. Okay. Take care.